Well, let's talk markets now with Brian Vendig. He's Chief Investment Officer at MJP Wealth Advisors. Brian, thanks a lot for joining us. I've read some of your recent commentary, and you are in the camp hoping for some clarity on trade through the summer and in perhaps to the early fall. And some of the headlines from the G7 get-together in Alberta, in this country, are positive. For instance, Mark Carney, the Prime Minister, and Donald Trump, the President, both say that a trade deal between those two countries is possible within a month or so. Is that the type of news you're hoping to hear more of?
Yeah, good morning, Paul. I think all investors are looking for clarity on policy decisions as important as trade, because we've seen in some of the recent economic numbers that there seems to be a little bit of a weighing and an impact of tariffs on slowing different aspects of the global economy, Paul. So I think getting progress on trade and clarity on how these agreements are going to play out over the next 30 to 60 days based on the July 9th tariff pause, and then obviously China into August, I think is critical for companies and investors, especially as you think about earnings season right around the corner and companies trying to relook at those outlooks for the second half of 2025.
I've spoken to a couple of guests this morning who say that absent some resolution on trade, economic data, U.S. economic data, is going to deteriorate later this year, particularly economic growth data. Do you agree?
We've been calling for a slowing U.S. economy even before the uncertainty around policy decisions this year. So I think what investors should focus on is obviously data that shows the durability of the consumer, because in the U.S., 70% of the economy being services-led really is impacted by consumer spending. The retail numbers today, I think, show we had a pull forward in the past due to tariffs, consumer pausing a little bit on spending, but not as bad, I think, as people fear. I think the July and June data that's right around the corner will really give us a sense of the durability of the consumer. And then, of course, interest rates and the Fed, they're still probably going to be on pause until the early fall, but lower rates definitely will help to support the economy and spending. So in summary, definitely a slowing economy in the second half, but I don't necessarily think it's one that you can say that we're going into a recession just yet.
Okay, so with that economic view in the background, you think investors would be wise to balance their equity portfolios between value and growth, not really tilting decidedly in one direction or another, correct?
That's correct, Paul. I mean, I think just from a valuation perspective, you have to keep forward price to earnings ratios in mind. You have to think about, the level of price that you want to pay for that future expectation of growth. And there's still a lot of companies that have more attractive valuations than our friends in the AI or the mega cap tech space. Not to say that that investment thesis is not compelling. I think there's still more room to run there. But just looking at global industrials and financials, when you think about reinvestment in infrastructure and lowering regulation and the demand for energy, even some parts of healthcare, which has been lagging this year, it looks compelling. And I think you need to also think about companies outside of just the large cap space, mid cap stocks, smaller cap stocks, which really can catch a rebound as we get some of this clarity around taxes, fiscal spending, trade. These are all things that investors should be thinking about over the next couple of months as we get more information to make more sound decisions over the next 12 months or so.
Why would those things set the table for a rally in small and mid-cap stocks? As I've noted earlier today with other guests, when this year began, there was a lot of enthusiasm around smaller cap stocks. They were perceived, for instance, as being less trade adverse, less affected by negative stories on trade. What do you see setting the table for a renewed run in smaller cap stocks?
Well, they're really tied to what's going on, obviously, in the local economy, and also more dependent about maintaining a debt. And so if we see that the U.S. economy is going to continue to kind of chug along, And if you just look over the last couple of months, there was definitely a catch up there in small caps rebounding because they were disproportionately punished with all the uncertainty around the economy and trade and interest rates. But lower interest rates in the future, and we believe that inflation, we're in still a longer term disinflationary cycle, even though we're still far off from reaching that Fed target. Lower interest rates over the next 12 months, helped by the Fed, coupled with slowing demand that helps to keep interest rates and inflation down, and policy decisions that are focusing on fiscal growth in the short term, really should be favorable to smaller companies to have an opportunity to pay a catch up. And on the mid-cap space, as I was talking about before, really compelling companies there, obviously a little bit more durable, less dependent on borrowing, but from a valuation perspective, look attractive.
And let's finish with cybersecurity. That's another element, that's another sector, I should say, of the equity market that you like right now.
Yeah, definitely. I mean, I think cybersecurity sometimes is forgotten when you think about all the news around AI innovation and what's going on there. But cybersecurity, I think, is more and more important as you think about geopolitical conflicts. You think about what's going on in building out a safe AI infrastructure moving forward. And there's also just so many companies in the space that we're willing to speculate that over the next 1 to 2 years, there should be a lot of M&A transactions playing out as well, which would be accretive to some of these companies merging or coming together and consolidating.